Welcome to Talk Tickers, your shortcut through the noise of earnings calls to get you those core insights. Today, we're diving deep into a really interesting one, Petco Health and Wellness, ticker WOO, and their Q2 2025 earnings call. It's kind of a turnaround story in the making.
Yeah, exactly. And this call, it came after, a bit of cautious sentiment floating around. Remember those shareholder legal notices over the summer? That probably didn't help things. But wow, the market reaction to this call, it's been really quite strong. Signals a real shift, I think, in how investors are feeling.
A definite shift. Okay, so let's jump straight into the headline numbers from Q2. Petco really delivered a robust beat on profitability. GAAP EPS, that's your standard earnings per share, came in at 5 cents, which was way better than the consensus expectation of negative 3 cents. That's an 8-cent beat right there.
It is. And maybe even more telling, their non-GAAP adjusted EPS, stripping out the one-offs, hit 8 cents. The consensus there was just a penny. So really big beat. And what's fascinating, like you said, is how they got this margin boost without, a big jump in revenue.
Right, that's the crucial part here. Revenue, it actually missed slightly, came in at $1.489 billion. Consensus was looking for about $1.494 billion. So yeah, down 2.3% year over year. But the market's enthusiasm, it just speaks volumes about these profit improvements, tells you where the focus is.
Absolutely. It's all about the bottom line right now for them, it seems. And you see it in the other numbers, too. Gross margin expanded 120 basis points, is 1.2%, up to 39.3%. Pretty healthy. Operating income surged up over $40 million to $43 million. Adjusted EBITDA also saw a really strong increase, $30.3 million, hitting almost $114 million. That's 7.6% of sales now. And free cash flow looked good, too, about $54 million for the quarter. This isn't just, trimming fat. It feels more strategic.
Okay, so let's unpack this transformation journey a bit more. Management's calling this quarter establishing a solid foundation. Where are they actually in this process, and what's the kind of core strategy driving these profit numbers?
Right, so they're very clear they're in phase 2 of their big transformation plan. And phase 2 is all about this profit first reset. Which, it sounds like corporate speak, but it really means buckling down on the operating model, getting the retail fundamentals right. The big goal here is setting the stage for phase 3, which is when they expect to get back to actual profitable sales growth. But they don't really see that happening until 2026. So this disciplined profit now approach, that's the engine for the margin expansion we just saw.
A profit first reset. Okay, so strengthening operations, improving fundamentals. What does that actually look like on the ground? And how did they manage that really impressive gross margin jump and get SG&A costs down, that leverage you mentioned?
Yeah, it comes down to being much more disciplined, really, the margin gain.
Yeah.
That was driven by getting a better handle on average unit costs and average unit retail prices. Yeah. Basically, tighter controls, better processes for pricing, for promotions. They specifically mentioned moving away from, and I like this term, unprofitable sales or empty calorie promos.
Empty calorie promos. I like that. So basically promotions that might drive sales volume but kill your profit margin.
Exactly. Saying no to deals that don't make financial sense, even if it means slightly less revenue in the short term, it's disciplined. And on the SG&A side, that selling general and admin costs, down $36 million year over year. That leverage, the 150 basis points, it just means those costs are a smaller slice of the revenue pie now. Super efficient. And interestingly, over a quarter of that SG&A saving came just from optimizing employee benefits after they did a deep dive review. Shows they're looking everywhere.
Okay, so very focused internally on efficiency. But what about the brand itself? They brought back their old tagline, "Where the pets go." What's the thinking there? How does that connect with customers, especially if they're cutting back on some deals?
Yeah, it's a smart move, I think. It taps into their heritage, right? Tries to build more of an emotional connection. They're trying to make the stores themselves a reason to visit again, beyond just grabbing a bag of food.
Yeah.
They talked about doing unique events like free pet food tastings, Meet the Critters, even a Feed the Sharks thing for Shark Week.
Feed the Sharks. Okay, that's memorable.
Right. It's about creating an experience, something you can't get online. And they say it's working. Customer sentiment is up, net promoter scores climbing sequentially, high satisfaction scores for staff friendliness. It's about giving people that reason, that feeling to come into the physical store.
So making the stores destinations again, how does that translate into actual operational changes inside the store? What are they selling differently?
Well, they've been busy behind the scenes, too.
Yeah.
Things like dog and cat planning resets, basically optimizing the layouts, improving shelf stock levels, making sure products are actually there, better inventory accuracy. All this stuff makes the store staff more productive, helps the store's bottom line. And on the product side, yeah, they're giving more shelf space to the stuff that sells well, the higher productivity sexies use, improving those end cap displays. And that fun one you mentioned earlier, launching their first category for humans, pet-themed gifts under $20. Apparently, customers were asking for it. It's all part of trying to offer things you maybe can't find elsewhere.
Makes sense. Okay, so a lot of focus on the physical stores. But, e-commerce is huge these days. How's Petco doing online? Has that been part of this reset?
Yeah, e-commerce, it has been a bit softer for them. They actually admitted they deliberately focused on fixing the physical stores first in this phase. But the upside is the online channel is more profitable now than it was. And they've brought in a new leader for e-commerce who's apparently already finding ways to, reduce friction, improve the basics. Things like website speed, page loads, making appointment booking easier, improving the repeat delivery service, just making it work better. Plus, they're planning a big loyalty program relaunch for 2026 with more personalized rewards. That could be significant.
Okay. And you mentioned earlier something called the North Star Initiative. Sounds important. What exactly is that? What's the big picture view there?
Right, the North Star Initiative. Think of it as their big strategic blueprint for the future. They basically reimagined everything. And it boiled down to 4 main pillars for growth. 1, that amazing store experience we talked about. 2, delivering services at scale grooming, vet hospitals, training, etc. 3, real merchandising differentiation, unique products. And 4, ultimately winning with omnichannel, blending the physical and digital seamlessly.
Okay, so those services, grooming, vets, that sounds like, where they can really stand out, right? A moat, maybe?
That's exactly the term they used. Services are their moat. It's that ecosystem, that combination of things that pure play online retailers just can't easily copy. It builds loyalty, drives repeat visits, and offers higher margin revenue streams. It's key to their whole strategy, I think.
Got it. So looking ahead then, what did they say about guidance for the rest of this fiscal year, 2025? And what are the big things to watch out for?
Okay, guidance was actually pretty positive. They raised their full-year adjusted EBITDA forecast, now expecting between $385 million and $395 million. That's a solid 16% increase at the midpoint from what they guided before. So management's feeling more confident. Net sales, though, they're still expecting to be down low single digits for the full year. That includes closing about 25 net stores. For Q3 specifically, EBITDA should be around $92–94 million, up maybe 15% year over year. But sales in Q3 are also expected to be down low single digits. They mentioned they're lapping the toughest sales compare of the year.
Okay, so comparing against a really strong quarter last year makes growth look tougher now.
Exactly. And one other thing they flagged was tariffs.
Right, tariffs. What's the outlook there?
Yeah, they expect those headwinds to get worse in the second half of this year, sequentially more impactful in Q3 and probably hitting hardest in Q4. But they also said they've been proactive with pricing adjustments already to try and mitigate that. And because the first half was strong profit-wise, they feel they have some flexibility now to maybe make some selective investments to tee up that phase 3 growth for 2026.
Okay, so putting it all together for investors, these Q2 results, they really do seem to signal that this profit-first reset is actually working, right? I mean, the pet industry overall, spending still projected to grow, $157 billion next year. But the pace has cooled off. So Petco's laser focus on margins and efficiency, it seems to be paying off right now.
I think that's right. The market's reaction, being constructively bullish, tells you investors are rewarding them for beating those profit expectations. They see a clearer path now to sustain profitability, even if the top-line sales growth is going to take longer, not really expected until 2026. That focus on higher margin services as the differentiator, plus the plans for digital and merchandising, it positions them well. Right. And honestly, raising guidance after 2 beats in a row, that does a lot for management credibility.
Definitely builds confidence. Okay, so let's shift gears for a second. For you seasoned investors listening in, thinking maybe a bit more creatively about Petco, given this focus on profitability, the margin expansion, the market liking the story, here's an idea. And let me stress, this is purely for discussion, entertainment, absolutely not financial advice. Do your own homework.
Right, disclaimer noted. But okay, here's a thought, sort of a conviction play. Think about Petco's timeline. Management's explicitly saying, hey, positive comparable sales, probably not until 2026. Their new e-commerce leader, just getting started. The big loyalty program relaunch, that's next year too. So maybe, just maybe, The market is still underpricing the full potential of Phase 3 when growth does return. What if that e-commerce revamp and loyalty program really connect? What if operational discipline holds? You could see a significant revenue reacceleration then. So the idea isn't about catching an immediate bounce. It's more like a longer-term bet, maybe using something like out-of-the-money call options expiring mid to late 2026. It's a bet that they successfully execute this whole long-term plan, navigate the tariffs, and the stock eventually reflects that delayed but disciplined growth, pushing it well past where it is now. It's for the patient, I guess.
Interesting. A longer-term conviction play on the turnaround, fully materializing. Okay, so let's recap this deep dive. Petco's Q2. Strong bottom-line performance, driven by disciplined operational improvements, better margins. That led to that significantly raised profit outlook for the year. Revenue's still a work in progress, yes, but the strategic reset, the focus on profit, clearly hitting the right notes with the market right now.
Yeah, absolutely. We'll definitely be watching, how this transformation continues, especially the impact of those tariffs in the second half and how quickly they can ramp up e-commerce and get that loyalty program going as they head towards that Phase 3 growth target in 2026. Can they really turn those empty calorie promos into a sustainable, profitable growth engine? That's the big question, isn't it?
It really is. Well, as always, it's Talk Tickers. And just a final reminder, any trade ideas we kick around here, purely for discussion and entertainment, not financial advice. Always, always do your own due diligence before making any investment decisions. Thanks so much for tuning in. We appreciate you listening and always welcome feedback. Join us next time for another deep dive.